So thank you, Michael, for joining us today at Landco. We really appreciate you taking the time to do that. For introductory purposes, Michael Purves is with Tallbacken Capital Advisors. It's a macro research, macro strategic firm located in New York City, and he's going to be talking to us today about a variety of topics. And so with that, Michael, let me ask a question. What do you see today as one of the biggest challenges in the real estate industry in the U.S. economy?
I'd say one of the biggest challenges in real estate is, I think, one of the biggest challenges for my day job, as you know, is working with Wall Street investment firms. I think it's a sort of an overarching issue for everyone. Is understanding inflation and understanding, I think, the complexities within inflation and what it might mean for asset classes like real estate, what it might mean, and for interest rates and all these related topics.
So the interest in that is such a complex set of topics. If you had to pick, what would you say makes it so challenging?
Well, I think if you step back, here we are just in the beginning, the first couple of months of 2022, coming up on 2 years of COVID, and COVID hit like a meteor, right? People were not expecting it. It hit, and you had this amazing concurrence of three pillars of sort of inflationary forces. The two obvious ones are massive monetary stimulus from the Fed, as well echoed by central banks in other countries. And also by massive fiscal stimulus. There's a third pillar, which I think is also kind of related to that, which is simply it's kind of a coincidence, but the rise of this sort of environmental investing there has been also very inflationary because, at least thus far, it means that things like the shale supply response to higher oil prices is not what it used to be, right? And that means higher, longer oil prices. Higher, longer oil prices spill into critical things like food prices and so forth there. So it creates a lot of tension at obviously for the Fed, but it creates a lot of tension, I think, for any elected official during these times, because I think there's a underappreciation that ESG, whether it's from policy or from people just saying, "Hey, I don't want to, have banks or the stock market support hydrocarbon companies," that they're, the offset of that is that it means higher oil prices until we get off oil, and that's not going to happen.
I see.
2022 or 2023.
And I'm
so there's this concurrence of these forces, and how they fade they're all fading in different ways and at different rates. That creates a lot of confusion and complexity in the inflation discussion.
Yeah, and I think for our listeners, watchers, all of this comes back to real estate and perhaps how it affects mortgage rates, what kind of predictions we might be making based on what we see today on mortgage rates, and how those may be affecting cap rates. So with that, I'll turn you loose.
Well, I think one of the fascinating things about this relationship of inflation and interest rates, and like just last week, we had yet another record print in inflation there, but its impact on interest rates is all in the front end of the Treasury curve, right? So 2-year yields are soaring through the roof. And look, 10-year yields when I say 10-year yields, I'm referring to the 10-year Treasury note yield, they're climbing higher, but they're climbing higher at a much slower rate than the 2-year yields are going up. So that's what we call a yield curve is flattening or coming in there, which raises a whole bunch of other questions and issues there. But I think the broader thing, of course, is that the longer dated interest rates that, of course, have a big impact on things like 30-year fixed mortgages in the residential sector and so forth, have been really pretty stable, really, over the last 9 months. And it's pretty remarkable given that these rates are so low with inflation so high. We have inflation at early 80s levels, and interest rates at levels we've never seen before in our country's history. So there's a lot of reasons for that, and I can get into that if you want. But I think that's one of the really interesting things is understanding and contextualizing that the inflation that you see when you walk into a grocery store or to a Home Depot, or when you're buying a house, or you see it in wage inflation, right? You're not seeing that same pressures in long dated, there's market-based expectations of inflation called break-evens, and you're not seeing it there. It's all in the first 5 years. So, the head of the Federal Reserve, Jerome Powell, has been lambasted for talking about transitory inflation. But in a way, the bond market is basically telling you transitory is between now and basically 2025, right? And so a lot of inflation then, and then we're going to go back to that sort of lower, longer, lowflation, if you will, that defined so many of the years after the financial crisis of 2008 and before COVID. That decade, right, was very low, stable inflation. That's what the sort of the Treasury curves and these inflation break-even rates are in telling us, is that we're not going to go back to the 1970s or 80s, even if it feels like it for the next 2 or 3 years. Not going back on sort of a permanent structural basis.
Okay. Very interesting. Well, let's go across the ocean and talk about China for a minute. I'm going to read a question if I can. What do you see being the problems in the Chinese construction real estate market, and how might they affect the U.S. or the West Coast in particularly?
Well, I think the China China has been has had a huge amount of fixed investment, real estate being part of that for so many years, and they've been certainly China bears have been waiting for this straw to break a camel's back that we saw over the past year with the Evergrande situation there. I don't focus too much on China local specific issues, but I would say that if you look at the macro condition in China, whether it's the interest rates or their foreign reserves, it's absorbing this really well. The macro condition in China seems to be really pretty strong, even though they're locked down and even though they've had this horrible construction blow up there, which sort of informs us that they've been sort of containing the situation there. I don't want to get too Wall Streety on you, Mark, but you can see, if you go back to 2015, when there was a China hard landing risk that happened in the summer of 2015, it really was felt over here across every asset class there. Like China hard landing, that was going to be bad. Currency got sort of suddenly devalued there, and you could see it in things like the Korean won. Options on the Korean won were very sensitive to it. Or things like over here, the VIX, which tracks U.S. equity volatility, was very sensitive to it. This time around is very different. Like the Korean won is, Korean won is very sensitive to anything good or bad in China because they're a huge trading partner and they're right over there and it's very liquid. The Korean won options are not they're kind of ignoring it right there. I would flag one potential thing though for China, which is that it's going to be a burden, with if this overhang of housing prices doesn't produce a sort of a big shock for the world, right? The way we did back in 2008, our housing situation. If that's not really in the cards here, what may be more obviously in the cards is that the household wealth situation in China will be burdened by deteriorating real estate prices there, and that can flow into consumer spending, and that might impact some facets of the California or West Coast economy here that has some exposure to that there. But I don't really see any direct transmission of that over here, other than if there's been real estate clusters that have been heavily targeted by Chinese, that might be a little less obvious going forwards than it has in the past.
That's very interesting for me. I'll wrap up with this and then let you talk to me about the Super Bowl possibly. But one of the questions that probably should be asked is, what tools do we see in the public or private? Let me repeat. What tools do you see? Let me repeat. What tools do you see in the public or private toolboxes to address the questions we've been talking about earlier, like the inflation and other aspects of the economy?
Well, that's sort of a long discussion, and it can go in a lot of different paths. But I think one of the things, I think there's a lot of dichotomies right now within the economy. So, for example, you talk about inflation, you talk about real estate. Well, housing prices, as we all know, have been going up and up and up and up, right? That's because of very low mortgage rates, which are tied to very low treasury rates. The Fed is obviously gone from extreme dovishness to a much more proactive hawkishness as they need to catch up with this sort of resurging inflation that we all see, right? And that's part of their mandate, of course. And so I think the question is how quickly does housing cool off there? But there's another dimension too, where as we're all getting into 2 years after our 2-year anniversary of COVID, is what happens to the central business district, right? Where a lot of the utility of a lot of central business district office space, which is very expensive. How is that going to be reshaped going forwards? How is that going to impact risk premium for investors who buy those assets? What happens to those cap rates, even if the back end of the Treasury curve remains low and stable, continues to do so? How do those get repriced? And I think, and this is your job, not mine, but I guess the question is what opportunities are there for people who are sort of seeing these pivots and structural pivots in real estate trends to take advantage of assets which may be distressed but still have economic value, but in a different way than what they're typically associated with.
I like that answer. And it is kind of a segue into, what do we see? And it's, for the most part, been a business of valuation of assets. And what we're recognizing, and I think certainly the CBD market recognizes, is that the highest and best use for a lot of these assets may not be what the original intention was. And having said that, like anything, it's what is the asset worth today? And we understand this to be the case in a lot of cases, and we predict a lot of repositioning. And as such, it's our job to not just from a macroeconomic level, but from a forensic level, much more so, to make a determination about what those values are, and then essentially implement an acquisition strategy that embraces that. So yeah, we do see all sorts of different and alternative uses for all kinds of assets. And you brought the example up of central business district. How are people utilizing central business district spaces today versus 2 years ago? Anyway.
And Mark, I think one of the sort of related concept and set of issues towards that repurposing is going to come in how can the costs of that be appropriately managed. As it's tempting to think of a giant office building in Midtown Manhattan or downtown San Francisco as a sort of this big static thing that has cash flows of X or cash flows of Y and then a discount rate. But in the repurposing and redevelopment, that may require steel, that may require concrete, that will require construction crews, and all of which are at very inflated prices, right? I mean, steel prices continue to be at very, very high prices. And so the same can be said for so many commodities. Construction crews are stretched, right? You're seeing articles about, big land developers, home developers that just, their crews are stretched, they're worn out, they can't just do everything that they want, even with the demand there to do that. So I think that's another, dimension of this whole thing, is how do you successfully, pivot on a strategic asset, but do it in a way where the construction or the pivoting costs, if you will, are managed, because that is one of the, of course, the equations in anyone's return profile for one of these investments. But there's one thing is very clear, that there's going to be a lot of very interesting and dynamic situations evolving between, so many forces that were unleashed sort of at once, and now are, getting into their sort of second or third stages, and it creates a lot of opportunities and a lot of interesting opportunities and new risks to consider.
It does, and in every kind of a market, whether it's a distressed market by whatever definition that means, or a robust market, inflationary market, these opportunities are lurking below the surface always. There's just it's the nature of change against a relatively static asset class that creates the opportunity, and that's our job to look for it. But it's a fool's bet to do it, outside of the sort of backdrop of what's going on in the macro economy and what's going on in the micro economies around in any of these areas that we choose to focus our strategies. And that's why bringing you into this equation and talking to somebody like you about it is very, very, very helpful. It's a different set of lenses.
Well, the macro and the micro are always connected, right? It's just, I think it's always important to sort of weave back and forth between your world in the micro, very specific situational world, where and my world, which is much more, a bit more abstract and all that, but it's all related, right?
So it was interesting having a Super Bowl fall on the Sunday preceding Valentine's Day. I don't need to go into too many details, but mine was supplemented by the fact that my 16-year-old daughter, my daughter's birthday is on Valentine's Day as well. So we had to celebrate it, of course, on Super Bowl Sunday. The fact that she's 16, and today, the day we're doing this interview, is her birthday. So with all of that confusion, I got to peek at a few sequences. And found the game to be one of the most interesting, most entertaining Super Bowls I've seen.
It was a bowl that was super. That's for that. I mean, look, it's been a great playoff season. I think we can all appreciate that. But I do think, Mark, that the government needs to take a cue from Cincinnati, which closed its schools today, and just make the day after the Super Bowl. If they're going to keep it on Sunday nights, just make it a national holiday.
Could be just a national holiday anyway.
The market so that we can all adjust appropriately.
I don't have a problem with that. I can only predict what's going on in Los Angeles at the moment.
Oh my God,
it's probably nuts down there right now. How are they going to deal with it in California?
Yeah, no, I know. Well,
yeah, really wild stuff. Anyway, this has been a fantastic opportunity to talk to you, and I thank you for your time. And until we do this again, Michael, thank you very much. Michael Purves, Tallbacken Capital Advisors. Thank you,
Thanks,
Michael.
Mark.